Hi, I'm James Robinson, and this is my stock pick of the week. This week, we're doing our fifth and final video on the company's Standard Motor products. This video is on wealth creation. So we've talked already about basically what the company is. We've talked about their operations, which is how good a job the company does delivering goods and services. We've talked about the balance sheet, and we've talked about dividends. What is wealth creation? Well, when a company makes profit, what you'd expect to see or hope to see as a shareholder is that those profits will transition from the company to the shareholder in one of several different ways. And so what we're really looking at is how good a job is the company at doing it, converting earnings to wealth for the shareholders. And there's a number of tools that a company can utilize to make that happen. They can reinvest money back in the company and grow the company. They can pay down debt. They can keep cash or build their cash reserves. They can pay dividends, or they can buy back stock. And usually companies do some combination of those things. And how efficiently and how effectively they do those things can measure how good a company is doing in terms of building wealth for the shareholders. For example, if a company was to retain 100% of its earnings, reinvesting in the business, but that reinvestment made no additional money in terms of additional profits, then one could say that money was wasted. If the company buys back shares at a price that's too high, then the difference between the value of the shares and the price they paid would be wasted. So what we want to do is just look at what's happening with our profits and what's happening with the earnings and how that money is being translated into what we'll call things that are likely to make the stock go up. So that's, without further ado, what we're going to talk about. So the first tool that we're going to talk about is the ability to pay down, is the buying back of shares. So what we really just look at here is shares outstanding. Is the number of shares outstanding increasing or decreasing? If the number of shares outstanding is increasing, that's a very bad sign. That means that the company is not able to fund or finance its growth through its own operations, and they're diluting us as shareholders in exchange for that. And I'd need to see really, really, really rapid income growth to justify that. And generally speaking, those are the kinds of companies I invest in. So how is this company doing? Well, in the last 10 years, it's bought back about 0.1% of the shares of the stock. Not enough to move the needle. It's better than selling shares, but the buying back of shares is not really significant and not something that we would analyze as making this company more attractive. So that's a lever that this company is not pulling to create wealth for the shareholders. It's not a big deal. Some companies don't do that. Some companies do. It's just where we are with this company. So I wanted to talk real quickly about better ways to follow me and follow my investing. I don't get a chance to make videos as often as I'd like. I'm busy with my day job often, family commitments, vacations, etc. So sometimes it takes me a little bit of time to get these videos out. If you want real-time information when I buy or sell a stock, or when I see information I think is relevant to one of our companies or to the market in general, you can find that on my Twitter page. My handle is @RobinsonStocks. So again, real-time information on trades, updates when new videos are posted, and news and thoughts on the market can be found there. Also, I'd like to thank all of my subscribers. I have 376 subscribers. Obviously, the goal is to get to 1,000 subscribers. That's the first tier at which you can start making a little money off YouTube. Not that I plan on making a lot of money off of this, but it'd be nice to be able to take my family out to dinner or something. Finally, you see here a map. This is where my known subscribers are around the world. It's really kind of cool for me to see that people all over the place are following me. So if you're following me and you have a second, just drop me a line in the comment section and say, hey, James, I'm following you from, Zimbabwe, or from, China, or from Tucson, Arizona. Wherever you're from, I'd love to hear from you. Thanks. Looking at the chart that we just had in terms of shares, looking at them more deeply, the way I kind of look at it is if you bought 10% of SMP stock at the end of 2009, you'd own about 2.2 million shares of stock. Today, through share repurchases, that same 2.25 million shares of stock would mean your ownership of the company has gone from 10% to 10.08%. So it's gone up. It's about a 1% increase. I said 0.1% on the last slide, but it's about a 1% increase. It's not nothing, but it's not enough to worry about over a 10-year period of time. However, your earnings per share would have gone from about $2.2 million. So your share, 10% of the company's earnings, would have gone from $2.2 million to $5.79 million over the last 10 years. And your earnings per share would have gone from 0.97 cents per share to 2.57 cents per share. So about 163% increase. So in addition to the dividends that we got, we've had about 163% increase in the value of the company over 10 years. at least, I say value of the company, at least increasing the value of the company's earnings, which should reflect in the company's value. So stockholders' equity. Stockholders' equity is the value of all the assets of the company minus all the debts of the company. And you can see since 2008, the stockholders' equity has gone from 150 million to 600 million. It's a 400% increase. There's no direct correlation between stockholders' equity and the value of the business, but they're also not completely unlinked. And it is a good sign that we are building some equity in the company. Generally, there is some correlation between stockholders' equity and price, but it's not dollar for sure. Sometimes you see stockholders' equity per share increasing disproportionately in the stockholders' equity. That's a result of the purchasing back of shares. It also works inversely if the company is selling shares, that the stockholders' equity per share can decrease even though the shareholders' equity, for example, remains flat. So that's the kind of thing we like to take a look at. It's not really that important for this company, but it is one of the things that sort of goes into our analysis. One of the most important things for me when I look at a company is return on assets. It takes money to make money, and you have to have money for, plants and equipment, especially for this kind of business. What I want to know is, that's fine that you're utilizing all that money to make more money. How efficiently are you doing that, right? And so we look at that as return on investment. We want a return on assets, and we want to make sure that we're getting a return on assets that justifies the tying up of those assets. So about 11% puts in the top 10% of companies, about 6% puts in the top 25% of companies. This company's consistently been in the top 25% of companies in terms of return on assets. So I like that. I like that the company's getting significantly better than average return on assets, and it's one of the reasons why I'm willing to buy this company. Generally, manufacturing companies tend to be capital intensive. They need lots of capital because they need lots of equipment and they need lots of factories and on and on and on. And so with those capital intensive companies, I really need to be sure that I'm getting a return on my assets. And with this company, I really am. A lot of people think that return on shareholders' equity is more important than a return on assets. And I don't think it is, because shareholders' equity can be diluted by debt, right? So let's just say we had $1 billion in assets and we have $900 million in debt. That means we have $100 million in equity. If you look at the return on that for the same business, you'll see the return on assets would be much lower than the return on equity. It'd be the same profits, there'd be the same amount of risk. You just have this huge amount of debt that actually makes the debt significantly higher. So I think return on equity can be bastardized through debt. And since I really, really don't like debt, I think that focusing on return on equity oftentimes rewards companies for debt, and I want to discourage debt. And so I don't give nearly as high a marks for a high return on equity as I do return on assets. However, having said that, this company is above average in return on assets, only barely. But again, when you consider the company has no debt, the return on equity is really significant because they're competing with companies that could be very, very levered up. Another tool that a company can use to theoretically build wealth for shareholders is to retain those earnings to grow the business. Obviously, every company needs to retain some amount of money to repair, replace, fix parts and equipment, to build new factories, to perhaps buy other businesses. So I'm not really opposed to companies that do that. I don't like companies, however, that have very high retained earnings unless they prove to me they can generate results from those earnings. This company's retained earnings have been very, very flat since 2011. They've basically been completely flat, and that's despite the fact that the earnings have more than doubled. So that's fantastic. That means that they are retaining a lower and lower percentage of their earnings. I really like that. Obviously, the retained earnings in time really do add up, as you can see that even retaining a little bit, like they have been, has gone from $100 million in retained earnings to $500 million. I don't worry about that so much. What I worry about is how much additional profit are we getting in exchange for those retained earnings. So what I've tried to do to figure out that answer of how good a return am I getting for those retained earnings is I basically I've oversimplified things. I've simply said, okay, what's the total amount of retained earnings that a company has had over the 10 previous years? And what is the increase in earnings over those 10 years? And I've basically given the management the credit that 100% of those earnings of additional earnings are the result of retained earnings. And so what I'm looking for is companies that can get a return on retained earnings of higher than 10%. I know it's an oversimplification. I know there's 100 other things that might have caused those earnings to go up. that might have nothing to do with retained earnings. But my attitude is, in the long run, in the aggregate, this is a pretty good way of determining how efficiently retained earnings are being used. And you can see that this company has been above that number every year for the last 10 years. So the fact that it's retaining earnings doesn't bother me, because I seem to be getting a profit for those earnings. And it bothers me even less because retained earnings as a percentage of income has gone down over time, which again leads me to believe this company is being more and more efficient with the capital they need, and they're generating earnings for the capital that they keep. So I like that about the company. It's one of the things that made the company very interesting to me in the beginning. There's no substitute for cash, and one of the things that a company can do with their earnings is simply keep it in cash, basically hoard it for a rainy day. I don't have a problem when a company does that to a certain extent. Apple, for example, one could argue has way more cash than they need and should be returning it to the shareholders. But I do recognize a company needs a certain amount of cash. I don't have a problem with a company keeping some cash. This company has done a pretty good job. Their cash has basically been, constant since it's no higher now than it was in 2006, and it's been pretty constant. Although since 2013 it has been gradually going up, but it's a much bigger company than it was in 2013. And because the company has no debt, I don't really mind that it has sort of this amount of cash. $20 million in $1 billion company is not very much. One could argue they could have significantly more than that and it would still be okay. If they had 50 or $60 million in cash, I don't think it would bother me. But it's easy for them to borrow money if they need it so they don't need to hoard the cash. But long story short, one of the things this company is doing with their money is not really hoarding it for cash. So this chart looks at total wealth created for a 5-year period of time. The orange line is the total amount of wealth that the company has created for the shareholders over the previous 5 years. And that includes a change in debt. So we talked about that if the company takes on debt or pays down debt, that's something that creates improvements or reduction in the value of the balance sheet. If the company pays dividends, I give the company credit for that. That's money they gave me back as the shareholders. Did the company buy back stock? That shows up here as well. Has there been an increase in cash? And so then we have the wealth created that year, and the orange line is the cumulative wealth created. And this company's been creating between $50 and $60 million of additional wealth for the shareholders, both directly and indirectly, every year since 2013. It seems like it's pretty flattened out at that number, and I'm very comfortable with that number. And so the wealth creating for this company is pretty solid. Generally, certainly in the top, 10% of the companies that I've looked at. And so when you look at S&P through all of the filters that we've looked at in these 5 videos, you understand why I've made the investment, and hopefully you've made the same investment and we do well with it. When I talk about wealth creation, the last slide is always how my portfolio is doing. And so here you can see what my portfolio currently consists of. Long story short, we're up about 22% for the year. Not bad for 8 months. Of the stocks that I own, one of them is down. Ryanair Holdings is down 0.28%. Again, with the Delta variant, I don't think that should be a surprise. I had bought that stock when I thought we were coming out of COVID. It seems we're having a bit of a relapse. I'm still not worried about it. I think that company's going to do great for us over time. Graham Holdings is down 7%. Graham Holdings is also very much tied to travel. They've got a huge business that does language learning, and they also have a lot of classroom type classes, classroom type businesses, for other non-language related things. And that stuff is all sort of being hammered by the COVID thing as well. I'm not worried that stock's going to come back. I recently, just today, made a purchase of Lazy Boy, bought it at $34.86. So actually, that number, that 0.43, is a little bit dubious because that's based on yesterday's closing price, which is slightly higher than the stock was when I bought it. But long story short, things seem to be doing great. We're up over 2% dividends for the year, so we've already made enough money in dividends that we will earn more in dividends than the S&P 500 has. We're about 1.5 points ahead of the S&P 500 for the year in terms of our performance. And, we've got some stocks that are up very, very significantly, 50%, 75%. So we're doing great. I'm very, very happy. The portfolio is doing well, and hopefully you've been investing along with me. And if you have, you've made a little bit of money. Thanks.